Oh, good morning, everyone. Welcome. I see some familiar names. Hey, Chelsea. Good morning. Are you here? Should pop out. Julie. Excellent. I'm seeing a lot of names from our symposium. This is excellent. Thank you all for joining us this morning for our quarterly, and happy Friday. Situated. As everyone comes into the Zoom, just take note, we've got a lot of events coming up, and just about every month throughout the rest of the year, we're going to have something, including our next quarterly in October. We're pushing to have that in person. Of course, we're going to be vigilant with regard to cases and what we need to be doing to be safe, but that is our goal, is to have an in-person safe quarterly meeting in October. But until then, we have events in August, September, and we look forward to seeing everybody then. Okay. And so with that said, I wanted to go ahead and introduce our first speaker. We're actually going to talk to Kay Sabetta for a little bit. She is representing AARP of Georgia, one of our sponsors this year. Lucky to call her a friend as well as a colleague. And just wanted to say thank you for joining us this morning, Kay. We're going to get a slide up for her there's her beautiful picture, love it. And then we will carry on and talk to a couple of other people before we introduce our guest speakers for today.
AARP is working to make communities more livable for people of all ages. But what is a livable community? In a livable community, people of all ages can find housing that is comfortable and affordable. It is also a community where residents can get where they want and need to go, regardless of whether they own a car. It's a place where people can spend time in parks and public spaces that are vibrant, safe, and healthy, so they can socialize with their friends and participate in fun activities. A livable community ensures access to needed shopping and healthcare services. It's a place where people can work or volunteer and be included in community events and decision-making. So, what is a livable community? It's one where everyone can make their city, town, or neighborhood a lifelong home.
Thank you. I think I missed my cue there for some reason, Kristen. I apologize. But hey, this is the new normal. You're having to just go with the flow. And I love that video. It just makes me really happy. You notice me dancing. Thank you so much, Kristen. Thank you so much, FPA of Georgia, for being one of our sponsors. I just want to say really quickly that approximately 45 million Americans are 65 and older, and by 2030, that number will reach 75 million. Right now, one in three is 50 plus, and by 2034, the US for the first time will be a country with more older adults than children under 18. And let that sink in for a minute. We are aging at a rapid rate. So AARP and our livable communities initiative supports the efforts of neighborhoods, cities, towns, rural communities to be great places for people of all ages. We believe that communities should provide safe, walkable streets, age-friendly housing and transportation options, access to needed services and opportunities for residents of all ages to thrive and participate in community life. Thank you so much for this opportunity for us to share about who we are and our just tons and tons of resources. You don't have to be 50 to join us. If you are able to vote and you're 18, come on down. Thank you.
Thank you so much, Kay. And if anyone on the call today is not following Kay on LinkedIn, she is always posting wonderful resources, like she mentioned, as well as all of the activities and advocacy they are doing for our citizens. So thank you so much. With that said, I want to introduce Dan Mineta. He is our representative from First Trust, also a wonderful sponsor. And really keep in mind that these individuals joining us here today, they help make all of this happen. We can have free attendance for quarterlies and appreciation events because of our wonderful sponsors. Thank you, Dan.
Yeah, no, thank you. It's always a pleasure being here with you all. Partnering with you in the mission that you're doing for your clients every day is an inspiration to not just me personally, but I know our firm First Trust. A lot of you have heard our CEO speak, so you know he sincerely believes in what you all do as the guardians of wealth for clients in this country. I think a lot of folks, I'm seeing the attendees on the call, a lot of folks joined us for our breakout session with our economist, Bryce Gill, a couple of months ago. So I thought what I would do for the couple of minutes that I have here, just give you a quick update. They actually changed their numbers, believe it or not, in between now and then. But for those of you who don't know First Trust, we're a large asset management and economic research firm headquartered out of Chicago, Illinois. I'm located in Georgia, so I get the benefit of working with you all on this call here today. So if you saw Bryce a couple of weeks ago, you'll know that we were bullish on the market. We actually increased, which is very rare for us, our outlook on the market and the economy. We take our outlook on the S&P from S&P 4200 to S&P 4500. The Dow from S&P 35,000 to Dow 37,500. But where we do have some concerns, I'm sure like a lot of you on the webinar today, is with the fixed income market. So our team sees the 10-year Treasury ending up right around 1.8 to 2%, which would be a pretty big move considering we just saw the 10-year go from 1.7 down to 1.2, right back up to 1.3. And we are concerned about inflation a little bit more than our friends over at the Fed are, who think a lot of this is transitory. Our economics team thinks that inflation is going to be in that 3 to 3.5% range when it settles out. So if you're looking for a quick idea on what to do for those clients who may be nervous about the market after hearing some of that data, or perhaps you're nervous about the market and hearing First Trust is bullish, you're wondering what to do, consider the First Trust Capital Strength lineup. We have them available in the ETF and the UIT wrapper. The reason we like Capital Strength today is that it's going to be able to help you up your quality in client portfolios. For example, if we take a look at FTCS at its last rebalance at the end of last quarter, we screen for balance sheet strength. That's our number one screen. Companies have to have $1 billion in cash or short-term investments to make it through our first screen. Cash balance sheets in FTCS stand at $3.7 billion. And to put that into context, the S&P 500 is at 1.8. So I know I only have 2 minutes. If you're looking for some information on other ideas that First Trust can provide, my contact info is on the screen right now. Feel free to reach out to me anytime. We'll make sure that we walk through any questions you have, economic, market, or investment related.
Thank you
Thanks,
so
Kristen.
much,
Happy
Dan.
to be here.
Yeah, thank you. We're happy to have you. Oh, and Kay just posted a link to the Livable Communities initiative with AARP. So please visit that. Thank you, Kay. And also I'll just say, Dan, thank you for addressing the term transitory. I feel like everybody has heard that with regard to inflation, and really just being bold to say, maybe it's not, maybe it's not. So thank you. Thank you for that.
Yeah, you got it.
So I'm so excited to introduce our first speaker, Michael Burns. He's going to be talking about practical planning steps in an outrageous environment. So I don't know, that drew me in when we were setting this up, in an outrageous environment. I think that's a wonderful word to describe what we're going through in many, many different ways. He is the managing partner at Scroggin and Burns, LLC. Michael focuses his practice on tax, estate, and trust planning. He serves as a board member for the Florida Tax Institute and has taught tax and estate planning courses as an adjunct professor at Atlanta's John Marshall Law School. Michael is licensed to practice law in Georgia and Florida. So very helpful, as I know a lot of us have clients in both states. So thank you, Michael, for joining us today.
Thank you, Kristen. I can say I, of course, like probably everyone on here, had Zoom issues this morning, and you think after a year and a half we would all be better at this, but I am clearly not. So what we're going to be talking today is some of the proposals that are out there regarding tax reform that is obviously going to affect a lot of our clients. And okay. So we are first going to touch on an overview of the proposed tax reforms. We'll talk about some of the planning strategies to address that and also do some real life examples as it relates to that. I will say when I decided on this topic a few months ago, I certainly thought we would have more clarity as to what this tax reform was going to look like. And my two thoughts on that was I was clearly wrong and I probably should have known better. I'm going to try to leave a few minutes at the end for questions, but if anyone does have any questions, please feel free to reach out to me. My email, m.burns@scrogginlaw.com. And of course, I am an attorney, so we have a disclaimer, and you can't blame me. We actually have a law school class that teaches this. But essentially today, what we're going to talk about is going to be a general discussion. Obviously, particular facts can change any advice, and state laws will vary dramatically from state to state. And to quote a Hollywood writer, especially when it comes to tax reform, nobody knows anything at this point. So the three main proposals that are out there that I'm going to kind of break up. The first is going to be the American Families Plan. And this is going to be the Biden administration proposal. They released this in what is called a Green Book proposal in late April. And it shows kind of the current objectives of the administration. I will say that each administration generally does release this every 4 years. But this year's is seen as a little more important given the recent election and composition of Congress. The next two that we'll touch on is going to be both the House and Senate bill, known as the Pascrell proposal and the Van Hollen proposal. And finally, we have the 99.5% Act, which of course is the Bernie Sanders proposal. One of the things I think that will probably end up affecting our clients more than anything right now, though, is going to be the sunset of the Tax Cuts and Jobs Act, particularly as it relates to transfer taxes. This is something that will automatically expire in 2026. Today, again, our clients have, or each individual has, an estate tax exemption of $11.7 million. This will automatically sunset in 2026. Okay, so first question is why now? Why are all these kind of tax reforms coming in? And the obvious is the recent election, but also, as you can see from this slide here, the CBO is projecting a pretty dramatic increase in the federal debt held by the public. You can see a particular spike as a result of the coronavirus pandemic. And I think, with politics today, there is not much bipartisan agreement out there. But I think the one thing that both parties can agree on is spending. We also have some looming state pension issues out there. So currently the 50 state pension gap is estimated at $1.24 trillion. The difference between the state retirement assets and the state retirement liabilities. I will note that there are over 20 states that are less than 2/3 funded and 5 states that are less than 50% funded. Social Security, we hear this all of the time. And again, the Social Security Administration right now is estimating that the current trust fund reserve will be depleted in 2035 under current laws. Again, we'll probably start hearing this more and more as this gets closer. So let's talk about the American Families Plan and kind of what I think is really the new reality from a tax planning side. It has been really for a number of years now, where income tax is really the new confiscation tax for affluent taxpayers. And certainly this is going to be one of the guiding proposals within the Green Book proposal. The income tax is annually renewable. It can be changed to, close loopholes. Whereas the estate tax, transfer tax, that is something that is typically only gathered upon passing. So what is going to be proposed within this proposal as it relates to our clients? I've kind of really designated 3 items here. The first is going to be the restoration of the 39.6% marginal tax rate. The second is going to be the elimination of the preferential rate for long-term capital gains and qualified dividends in excess of adjusted gross income of $1 million. And as it relates to transfer tax, the elimination of the step up in basis and treating death as a realization event. I think those last 2 are frankly going to be pretty significant if that were ever to pass. So let's go one by one on these. The first, talking about increasing that top tax rate back to 39.6%. This would apply to income over $400,000. And if many of you remember, the Biden administration did make a promise not to increase taxes on individuals making over $400,000. It's still not clear whether this is going to apply only for a married couple or whether this would also apply for individuals. You can see from this slide here the difference in rates as it has happened over the past 5 years. And with this new proposal, the biggest difference really would be the lower threshold for reaching that top rate there. I think what is going to be the bigger one, and is certainly probably causing a lot of consternation for our clients, is going to be the increase in the capital gains rate. And frankly, I think this is going to be pretty huge. Obviously, we probably have serious consequences on small business, family farms, clients that do have large realization events. And the proposal would be to raise that top rate over, again, AGI of $1 million and treat it as ordinary income. So in this situation, we're talking about a top rate of 39.6%. You would add in the net investment income tax of 3.8%, and then you would add in any state tax as well. So for a capital gain rate for a resident of California, they would be looking at a top rate of approximately 57%. Again, here you can see kind of the difference in years and the increase of that top rate there, even at a lower threshold than previously. The second piece of this kind of capital gain side here is going to be the elimination of the basis step up in treating death as a taxable event. And to clarify, again, if death is treated as a taxable event, obviously the underlying asset would receive a new basis in that regard, but there's going to be certain exceptions there for family business and things like that. One thing I do like to remind people is that we did have a no basis step up in 2010. That was accompanied also with no estate tax. But I can tell you from private conversations with the IRS, this caused significant problems from both a logistics and administrative side for them. I'm sure we have a number of clients out there. If you've owned a family farm for 50, 60 years or a business, a lot of times not only are those basis records incomplete, but frankly, they're probably not even non-existent. I can tell you probably some people even on this call have done remodels of their house, and trying to track down those records can be pretty difficult in and of itself. I do think the specifics of this are going to be really important, and that is something where there was not a lot of specifics laid out in the Green Book proposal. And why I think this is important is because the initial one here, we're talking about a $1 million exemption per individual, and presumably, again, this means the first $1 million of unrealized gains would not be subject to a taxable event. For a married couple, that would be increased to $2.5 million. There is a clause in there that says that there will be protections so that the family-owned business and farms will not have to pay taxes when given to heirs who continue to run the business. This I have a lot of questions on, frankly, and there's been a number of senators that have kind of come out that have pointed to this as something that is not going to affect family business, that is not going to affect family farms. But I will say, when you think about this practically, when there is an estate tax return or estate tax due, a lot of times what the IRS does is they place a lien on that business or on that property. So in this situation, if we have a tax due that is being deferred to a later date, does that mean that the IRS is going to have first priority from a lien position? And if they do, how is that going to affect the business seeking financing in the future? I can tell you not a lot of banks out there are probably going to want to be in a second position priority to the IRS. Additionally, how does this look? Is the sale tax, or is this tax going to be due upon the date of passing, or is this tax eventually going to be due upon the date of sale? Because there we're going to have different years from a capital gain, from a capital loss side. Frankly, I think there's going to be a lot more that needs to go out on this. And then the final point on this is there is also going to be an exception if there's a forced recognition, or an exception to a forced recognition if the property is donated to charity or passes to the surviving spouse. I think this is really easy to understand in estate plans that say everything goes outright to the surviving spouse. But what about if we're using a Q-tip trust? Especially in areas of blended families, this can be a very important question. And if this were to pass, I think, frankly, one of the most important things to do is going to be looking at traditional estate plans that have an AB trust plan or some type of formula gift where it would pass to a family trust. Presumably, in that scenario, there would be no exception there, and you could be looking at a tax due upon the first to pass. And again, one thing I always love to say is, in the estate tax world, we have Q-tips and slats and all these word acronyms. I think it's just to keep us estate planners in business. So let's look at an example of what this would do for an investor. So here we have an early investor in Amazon stock, fair market value today, $4.1 million, basis of $100,000. Under current law, you would see that the entire $4.1 million would pass down to the family, again, net of any state or estate tax. Under the current Biden administration proposal, it would result in $1.736 million in tax going to the IRS, the remaining $2.364 passing to the family. You can see this is a pretty dramatic proposal in regard to changing how it currently is. Retroactivity. So this is one of the big questions that we are getting, and unfortunately, I have no answer for you on this, other than to say each bill is kind of treating this differently. The House has a 2022 effective date for all provisions. The Senate bill has a 2021 effective date, and that would be January 1st, 2021. The Biden administration has proposed that only the increase in the capital gain rate would apply to April 28th, 2021. Again, my thinking here is that this is just being done to avoid any type of mad rush to selling or hitting the sell button. And that's something that frankly would probably end up affecting the stock market if it were not retroactive. Whether that will actually pass, I certainly think that's unlikely. But I will say from a constitutional side, the Supreme Court has already ruled on this and said that retroactive taxation of transactions is possible if rationally related to a legitimate government purpose. Different people on this call will probably have a different idea of what a legitimate legislative purpose is, but these retroactive tax reforms have been found to be constitutional in the past. And the administration has said, and again, you can see this quote from Treasury Secretary Yellen saying that she did not think that a retroactive taxation of future realization would be treated as a retroactive future. That certainly is a tongue twister there, but I think that is kind of what you're seeing from the administration as far as that goes. Memorable quote here, and it's one of my favorite. If Patrick Henry thought that taxation without representation was bad, he should see how bad it is with representation. So let's talk about the transfer tax side of these proposals. And really, I'm going to kind of break down three here. First, the Green Book proposal. Second, the 99.5% Act. And third, the Tax Cuts and Jobs Act. Good news, Green Book proposal, Right now, there are currently no proposals as it relates to reducing the estate gift or GST exemptions within that proposal. I will say that depending upon CBO projections, this can always change. I do think it's pretty unlikely given the fact that these are going to sunset in 2026 anyways, but I will note that the Biden during the primaries, Biden had proposed lowering the exemptions down to 3.5 million. So let's talk about the 99.5% Act. And here I have kind of summarized this one into one form for you. The IRS says, how much did you make? Send it to us. Of course, I'm joking here, but the 99.5% Act relative to the other tax proposals, I will say is much more punitive in nature from an estate and GST side. On the gift tax exemption, it was proposed lowering that down to $1 million, and this would not be indexed for inflation. And certainly a lot of you on the call here probably would argue whether this current inflation is going to be transitory or permanent. But again, not indexing this for inflation would be a significant potential issue for taxpayers moving forward. They are proposing lowering the estate and GST tax exemption down to 3.5 million. This would be indexed for inflation. And again, even the 99.5% Act is retaining portability. I will say that none of the proposals that I've seen, frankly, at all, since portability has been enacted, would call for removing that. And we do get clients every once in a while that say, why am I going to do a state tax return for portability when the law is just going to change 4 or 5 years from now? I do think this is something that is unlikely to occur. And frankly, I think portability is one of the best things we can do for especially our moderately or high net worth clients. I tell people it almost acts as an insurance policy against either an increase in net worth or Congress potentially continuing to change this throughout the years. And again, portability is obtained by filing that estate tax return by the surviving spouse filing that estate tax return within 9 months of passing. Finally, from a rate side, the proposal is calling for an increase of the rates, 45% over 3.5 million, 50% over 10 million, and the top rate would reach all the way up to 65% for estates exceeding $1 billion. And again, not a lot of us on this call probably have a ton of clients exceeding $1 billion, but from purely an academic standpoint, I do think this would be fairly interesting to see how it played out. You can imagine a Elon Musk or a Jeff Bezos, someone frankly that has over $100 billion of their stock. If they were to pass away, you can think of a world where that stock would probably take a pretty big hit immediately as a result of their passing. But I think that selling could even be worse because that estate tax is going to be due within 9 months. So you'd probably see some forced selling for a while there. And for a lot of our finance professionals on the call today, you'd probably end up seeing that as a risk section of a lot of 10Ks and risk factors that are there. Okay, so Tax Cuts and Jobs Act, and frankly, I think this is one of the biggest ones that is going to occur. We know January 1st, 2026, we're going to see a reduction in these exemptions from 11,700,000. And again, that is going to continue to increase for inflation. But in January 1st, 2026, that is going to revert back to $5 million indexed for inflation. And we're going to be looking at a scenario where our clients are either going to use this excess exemption between now and 2026, or it will be lost presumably forever. And the two kind of examples I would give here is in a scenario first where, again, looking in a world where we're probably around the $6 million index for inflation estate tax exemption in 2026. If we have a client that has made either no gifts, or in this case, $1 million in lifetime gifts, we're looking at a lost exemption of $5.7 million. Again, they would still retain the remaining exemption in 2026. However, for clients who are or able to make significant gifts prior to 2026, so in this scenario, we have a client that has gifted $11.7 million, they will have used an excess exemption of $5.7 million, And this is something that the IRS has confirmed, and this was a press release 2019-189, that there will be no clawback of the use of that excess exemption. Okay, so Peter Drucker, he said that trying to predict the future is like trying to drive down a country road at night with no lights while looking out the back window. Nevertheless, I'm going to try to make a few predictions here. Obviously, take those with a grain of salt. The first prediction is I think it is unlikely that the American Families Plan or any similar proposal will pass in 2021. The reason for that is that Congress is going to go to recess here in August. And when they return from recess, a lot of them will be starting to campaign for midterms. So I do think such a drastic talk about reforming the tax code in a tax hike is going to be very difficult to do prior to midterms. I'm not sure I agree with Senator Mitt Romney, who said that tax increases are off the table. I think it is more likely that we see some kind of moderate tax reform with maybe a moderate increase in the corporate tax rate or in the capital gains tax rate. With that said, my second prediction is I do think we are going to see state and federal taxes, income, and transfer continue to increase on the wealthy in the future. Given today's political climate, I think it is going to become more and more important to plan for income tax as part of the estate plan. Prediction 3 is that the current estate tax exemptions will sunset in 2026. Again, politically speaking, there's been a lot of talk about taxing the wealthy, income inequality. I think it is going to be very politically tough to either keep or increase these exemptions in the future. And with the uncertainty that we do have out there, one of the things I am stressing to clients is just trying to maintain flexibility with any type of planning technique. Okay, so that was 20 minutes on what the proposed tax reforms are out there. Let's talk about some strategies for planning for the uncertainty and unknown that is out there. And I think one of the best strategies out there from a transfer tax side is going to be the spousal lead access trust. And here you can see we have a diagram just kind of talking generally about this. But in the top left-hand corner, typically we will have a donor or grantor gift assets to this spousal lead access trust, also known as a SLAT. This SLAT is going to be irrevocable, and the grantor will have to relinquish control of those assets completely in order for this to meet IRS muster. The spouse can remain a beneficiary of the spousal lead access trust and can even be a trustee and or co-trustee of the trust itself. And from a client side, the donor or grantor could retain indirect access to that trust through the spouse. From a transfer tax side, the best thing about this is that it is going to freeze the value of that gift as of the date of gift, meaning that all of the appreciation of that asset in the future is going to happen outside of the client's taxable estate. And again, there are going to be a number of ways to maintain flexibility via this SLAT. Ultimately, upon the spouse's passing, the funds in the trust could flow down in accordance with the trust document, but presumably some type of trust that would flow down to the grantor's children and or intended beneficiaries. From a income tax side, this is going to be treated as a grantor trust for income tax, meaning that all of the income tax is going to be reported on the donor or grantor's individual income tax return 1040. We do get some clients that raise their eyebrow on this when we tell them not only do they get to gift away assets, but they actually get to keep paying tax on them as well. But this is something, frankly, that is going to be a pretty big benefit to that client over the long term, because all of those income tax payments are going to be essentially gift tax-free contributions to the trust, and it permits the trust assets themselves to compound tax-free without having kind of that annual tax burden there. So let's talk about some of the basics of this. Again, we talked about this is going to be irrevocable. The grantor is going to give up all rights. A benefit is that the spouse can serve as a trustee and or co-trustee and continue to be a beneficiary. The initial gift to the trust you can allocate GST exemption to this on the initial gift tax return. And what this means is that the trust is wholly GST exempt. Not only will the distribution of these trust assets to the first generation be estate tax free, but ultimately the distribution to the next generation, to the grandchildren, or even to the great-grandchildren, can also incur outside of the taxable estate. We'll touch on some asset protection that this is going to provide. One of the big things also is being able to include a power of substitution within the spousal lead access trust. So let's do a real life example here. We have Jennifer and Michael, again, not really original there with the name, are married with 2 children and a net worth of approximately $25 million. Jennifer establishes a trust for Michael, and she funds it with $11.5 million in high basis marketable securities. The reason I say high basis here is one of the disadvantages of this spousal lead access trust is while that the assets will not be included in the grantor's taxable estate, if the current law remains, there would also be no basis step up for the assets within the spousal lead access trust. So in a situation where we have a client gifting $11.5 million in a low basis stock, they're not really gifting $11.5 million. They're gifting $11.5 million less whatever the tax is on the unrealized gains in those securities. So in this scenario, we have the trust growing by $10 million to $21.5 million in 2028, when the estate tax exemption is $6.5 million. And again, there is a timely 709 filed to treat this as a wholly GST exempt trust. So let's talk about some of the benefits here. The first is going to be that we are utilizing the higher lifetime gift and GST exemption. By the client using that entire using $11.5 million of exemption, the excess $5 million is not lost in 2026. So in this scenario, if we're assuming a 40% tax rate, that's going to represent $2 million in estate tax savings. And as I talked about before, the IRS has indicated that there will be no clawback on that. Second, and probably the biggest benefit here is going to be that the appreciation of the assets are going to be outside of the taxable estate. Again, in this scenario where we have had $10 million in appreciation at a 40% rate, that represents $4 million in estate tax savings. The income tax payments by the grantor are going to be gift tax free. Again, that's going to allow the assets within the trust to compound tax free. And finally, assuming that the GST is allocated, not only is this going to pass down to the children, but it can also pass down to the grandchildren estate tax free. A huge benefit for the majority of our clients. Modeled some numbers out here, and one of the things that I will say about any type of planning strategy, but especially a strategy like this, is going to be the best thing that occurs is time. So time is what is going to permit the compounding of the assets within the trust, and that can be difficult when we talk with clients because frankly, most of the time when things are being done, there is a pending deadline or a pending tax reform coming in. And I fully expect in December 2025, things will probably be crazy. But one of the things I like to say to clients is the earlier you start this, the better the technique is going to work as far as tax savings goes. And so here you can see I've kind of done a 20, 40, 60-year periods at a 5, 8, and 10% growth. But using an 8% compound growth rate here, even at 20 years, we are talking about an increase of that trust to $53.6 million, a state tax savings of approximately $16.8 million. As you get down to 40 years, you can see those numbers start to get a little bit silly. And again, this is an academic exercise, but frankly, you can see the longer the time period, the better that result is going to be. And this is one of the ways that generational wealth is created. So we talked about flexibility as well. The nice thing about the spousal lead access trust, or frankly, any irrevocable trust that is going to be a grantor trust, is that it can also include a power of substitution. And this is going to be also known as a swap power. It is what permits the grantor to swap low basis assets for cash or high basis assets in the future. This is something we've done a number of this year, where we have had grantors, again, using cash to basically take low basis assets inside that irrevocable trust to pull it into his or her state for estate tax purposes. One of the other benefits from a flexibility standpoint is upon the death of the grantor, this trust, which was previously treated as a grantor trust for income tax purposes, will be treated as a non-grantor trust for income tax purposes. And at that point, an independent trustee would have the ability to spray the income that that trust produces among a class of beneficiaries. The example that I would give is if you have very high net worth children, high income children, but you have grandchildren that are in college, getting married, starting a business, that are in a much lower tax bracket, the trust can actually allocate that income down via a K-1 to those grandchildren to be taxed at presumably their much lower rate. And again, kind of doing some tax bracket management within the trust there. Again, if you accumulated the income within the trust itself, you would be reaching the very highest rates of income tax at $13,150. Again, we talked about the grantor having indirect access to the trust benefits via his or her spouse. One of the things to talk about here up front prior to doing the document, though, is what happens if there is a future divorce. The trust document itself should dictate whether the divorcing spouse is treated as a beneficiary or whether she would be treated as having predeceased. This is something that you get preferably in writing. You talk about with the client up front. And so if there is a subsequent divorce, there is not a surprise during the settlement conference. I can tell you some of my family law colleagues are particularly fond of these. And finally, including a limited power of appointment to deal with changes in children and or grandchildren in the future. It's impossible to predict how children are going to be 2 years from now, let alone 20 or 30 years down the road. One of the bigger planning objectives, frankly, from the spousal lead access trust and irrevocable trust is not only the tax side. We have had a number of clients, and particularly our female clients, that are concerned about protecting the assets against the surviving spouse remarrying and or subsequently getting divorced. One of the quotes I like is, "Marriage is often due to the lack of judgment, divorce due to the lack of patience, and remarriage due to the lack of memory." From a fact side here, 61% of widowers are engaged in a new romantic relationship within 25 months of their wife's passing versus 19% of widows. Widowers are over the age of 65 are 10 times more likely to marry than widows. One of the things we talk about with people is that, frankly, heirs of a remarried spouse have more to fear from that remarriage than they probably do from the transfer tax issue itself. So some of the, again, non-tax benefits here is that this trust is going to protect against that surviving spouse being remarried, getting divorced, and or having creditor issues. It's also going to protect against a child or grandchild being divorced or having creditor issues. And that is going to be presumably done through the spendthrift clause that would be within that trust document. One of the other ideas is it can provide harmony and tax efficiency for a family business, making sure that that stays within the family rather than being transferred to outside family members that may occur either voluntarily or through some type of divorce proceeding. And finally, the trust can be used to positively affect future behavior. This is a very sensitive subject, and I think there's probably some advisors that think it is a good idea for this dead hand control, and some advisors that are very much against it. I can say that all children are different. I have two of my own, one who is very analytical, likes numbers, reading, very calm, and she definitely takes after my wife. Unfortunately, my other one enjoys running into walls, jumping off the couch, and definitely takes more so after me. What I'm getting at here, though, is I think these spousal lead access trusts are a way, or even any type of trust, is a way to try to get adult children involved with the planning ahead of time. And by that, I mean meeting with the advisor, talking about investments. If there's a business involved, talking about how the business works. This is frankly one of the starkest differences I see with clients. And I'm not necessarily saying you have to divulge the net worth or divulge what the assets are within this. I'm saying is you're trying to promote some kind of financial fluency for the children. You're trying to avoid conflict via transparency and promote family harmony. Okay, so that first example there was a kind of simple, straightforward planning technique, probably for someone that doesn't necessarily have a taxable estate today, but that may have a taxable estate in the future. Here is a little bit more of an advanced example. We're going to increase Jennifer and Michael's net worth to $60 million, which is going to consist primarily of S corporation stock that is valued at around $40 million. Again, same idea here. Jennifer is going to establish a trust for the benefit of Michael and the kids, and this trust will be an intentionally defective grantor trust. Again, a grantor trust. The original example is a simple solution, probably for an average client. Here we're talking about something a little bit more technical, but it is also going to be a much more efficient use of the estate tax exemption because we're going to be able to take advantage of discounts and low interest rates. And so my recommendation in this type of scenario would be to initially recapitalize the company between voting and non-voting stock, essentially doing a stock split that is going to permit the grantor to retain the voting stock and for the grantor to be able to gift that non-voting stock. I will say that the non-voting stock will have to be appraised, and presumably that is going to include a minority interest discount and a lack of control discount. From what we are seeing today, and obviously depends upon the industry in the appraisal, but that discount can be anywhere from 30 to 40%. So in a scenario where a client is gifting $10 million worth of a business, the actual gift that is going to be reported is going to be anywhere from 6 to 7 million, depending upon the discount that is applied to that. In this scenario, if possible, I would actually recommend that Jennifer initially fund the spousal lead access trust with cash and subsequently purchase the trust itself would purchase the stock from Jennifer via either a down payment of that cash and a promissory note that would subsequently go to her. Here, we're able to use a smaller portion of exemption, but we're also able to transfer over a much larger percentage of the company out of her taxable estate. From a requirement standpoint here, the sale to the grantor trust must not have a below market interest rate. In other words, it needs to be at least the AFR rate. And I will say the current midterm AFR rate is 1%. Interestingly enough, I was looking up some qualified disclaimer regs yesterday. I promise not for fun, but for a client issue. And in the regs, it mentioned a bond interest rate of 12%, which I certainly thought was interesting. Looked up the date of the regs and it was in the mid 80s, which makes a lot more sense. But this kind of drives home the, frankly, historical nature of where these low interest rates are and the possibilities it provides for transfer tax planning. Second requirement here is that the grantor trust should have assets of at least 10% of the value of, and again, this is typically called a seed. A lot of practitioners rely on this 10%. Certain ones use more, certain ones recommend less, recommend talking to the advisor on that. One thing I would add is I think it's very important to actually follow the promissory note terms. So to tell the client up front, if we're looking at a 9-year note at 1% or a 10-year note at 1%, that 1% interest does need to be paid each year. And if it's a balloon at the end of that 9 or 10 years, I do want the trust to pay the balloon at the end of that 9 or 10 years or to renegotiate the terms of that note. And finally, the nice thing here in this situation is that the grantor trust will be wholly defective for income tax purposes, and therefore it would qualify as an S Corp shareholder, would not result in the corporation losing its S corporation status. So in this situation, the benefits are going to be even more extreme than that initial one. all of the appreciation of the stock is going to accrue outside of the estate, similar to before. But here we also have an initial 30 to 40% discount that is going to be applied to that private company stock. That discount is not free. If anyone's paid for a private company stock appraisal, they are not cheap. But I will say using a reputable appraiser will pay for its time many times over if you are doing this type of strategy. That is one thing I kind of am adamant about as far as a client using a reputable appraiser. Additionally, the difference between the AFR interest rate and the income distributions of the S Corp are going to occur also completely outside of the estate, meaning that the income that the S Corp is producing will be used to pay that 1% interest rate, and everything else there that is going to accrue within the trust can actually be reinvested into securities, real estate. It can be used to obtain a life insurance policy on the grantor, although you want to be a little careful there to make sure that you maintain grantor trust status. Again, similar to before, the grantor payment of the taxes is not going to be a gift for gift tax purposes, and we can maintain flexibility via the power of substitution. Frankly, my biggest question as it relates to this technique, which has been around for a good while, is whether it is going to be eliminated or reduced in the future. I will note that each of the Obama Green Book proposals, as well as the House and Senate bills, have provided for either decreasing the effectiveness of this structure by having either some kind of period where taxes would be due or eliminating it altogether. I will say that the current consensus of practitioners is that any elimination would not be retroactive. Okay, so third strategy we'll touch on briefly is going to be intra-family loans. And this can be applicable. We have some clients that just do not want any complexity. The trust is a dirty word to them. And I think this can be a vehicle that is used that they'll understand more cleanly. And frankly, that can maybe be a first step as far as planning for some of these taxes. Again, these intra-family loans, the effectiveness is all about the AFR rates currently. So short-term rate, 0.19%. I thought that was a typo the first time I looked that up. Midterm AFR, 1%. Long-term AFR, 1.89%. What these intra-family loans do is they're going to take advantage of these historically low tax rates. Similar to what the sale to that defective grantor trust did, this is going to be maybe a little bit cleaner with a little bit less benefit. But the idea is the rate arbitrage between what that child and or family member is ultimately able to retain from a return on capital side relative to what that interest payment is to the client. So again, the strategy here is simple. The parent loans the money to the child at AFR. The child invests the borrowed money in assets which produce a higher rate of return. And the difference essentially represents an estate in gift tax-free increase in wealth for the child. This can also be used to promote desired behavior. We had a similar client in the past. He was looking to promote kind of hard work, entrepreneurial spirit in a child. He loaned $1 million to purchase a franchise. The note was an interest-only 9-year note at 1%. It had a balloon payment at the end of 9 years. In this case, the child, again, different facts here, but the child paid the parents $10,000 per year in interest, that 1% rate on $1 million. But the business itself earned $150,000. The value of the business in excess of $1 million is a completely tax-free transfer of wealth. The one caution that I would say as it relates to intra-family loans is I do think there needs to be an actual note with actual terms, with an actual intent for that child to repay that note in the future. I think this is going to be twofold here. The first is you do not want the IRS to recharacterize this as a gift in the year that it is made. And second, you want the child and or family member to have some incentive to continue working, to continue doing that. So that note would actually, if it was known that it was going to be forgiven, some of that may be lessened in the future. Fourth strategy here is going to be a charitable remainder trust. And I think these are going to really become really important depending upon what happens with that capital gains rate. So a CRT pays an annuity to the grantor or another person for a period of time, and thereafter any remaining assets pass to charity. So let's look at a diagram here. You can see top left-hand corner, we have the donor. They are going to transfer highly appreciated assets, whether it be stock, private company, something that is going to flow into that charitable remainder trust, where it can be sold completely tax-free. So again, that initial transfer, the client is producing a low basis asset that is going over to the charitable remainder trust to continue to be invested. The benefit here is in return for that transfer, not only is the client not paying income tax on that sale, but they are also going to receive payments for the donor or the donor's spouse for a lifetime or for a term of years. Additionally, the donor is also going to receive an immediate tax deduction for the present value of that interest, and I will say it has to be at least 10%. Ultimately, though, upon the client's passing or upon the close of the term of years, the charity, a public charity, would receive whatever is remaining in that CRT. And again, that can be a donor advised fund that is the residual beneficiary there. The major strategy here is the idea of smoothing out income. So especially for clients that are selling their life's work with a business where they're producing a very large capital gain in one year, but not necessarily having an income in other years. If we do have a capital gains tax rate of 43.4%, that can be a pretty significant effect to that client, both from a retirement side, from a tax side. And we've heard certain people recommending, well, you can structure it as an installment sale, which again, may be a feasible strategy. But the issue with that installment sale, meaning that where the client is going to be selling on day one and receiving a note back from the buyer over a period of years, is what happens if the business ultimately goes under, the buyer's not able to pay that installment sale. You run into a number of other risks that frankly may even be bigger than the actual tax risk itself. So what the CRT is going to do is it's going to permit you to sell that business or that portion of business tax-free. And rather than taking all of that income tax in year one, where it's going to be subject to that 43.4% rate, it's going to permit you to essentially smooth out that income over a period of years, because that annuity that the client is receiving is going to be the taxable amount that they are going to have to pay. And again, this can be a way to avoid reporting that income from a large asset sale in a single year. The two cautions I would say here is that a CRT is not an eligible S corporation shareholder. So if a client were to transfer S corporation stock to the CRT, that could result in the loss of that S corporation election. And the other one is to avoid any gift of the debt finance properties, because you would run into a lot of unrelated business taxable income issues there. Looks like I've got a little bit longer. So one of the other items that I'm going to recommend here is to review prior trust agreements now rather than later, especially if we're going to be looking at tax reform, increased capital gain tax rates, increased income tax rates, frankly. And one of the things maybe to look at is whether to convert from a grantor to non-grantor trust status or vice versa, especially if there is a power of substitution within that document. It may be possible to toggle off that power of substitution, and all of a sudden you go from a situation where there is a grantor trust to a non-grantor trust. And where this may be done is where you do have children and or grandchildren in much lower tax brackets, where you may be able to transfer some of that tax down from the grantor at a very high rate to the beneficiaries at a much lower rate. I've been including this in a lot of presentations, but also looking for any potential 2036 inclusion issues. This is a little bit outside the scope of the presentation, but we have had some recent case law, mainly the estate of Powell, that has frankly scared a lot of practitioners, where we have LLCs or partnership interests where the grantor has retained some type of interest that could result in the entire trust being included in the taxable estate of the grantor. I think it's going to be important to look at potentially decanting trusts. So where we are any trust that it has either poor income tax situation or mandatory distributions of income, things like that. Decanting laws have significantly increased in the past here in Georgia, Tennessee, Florida. There are actually statutes on this that now permit you to essentially change the terms of the trust within reason. Obviously, always want to take a look and make sure there is not any adverse tax consequences to that. Looks like I've got about 2 minutes left. Some of the basic ideas that are out there, again, smoothing out income via installment sales. I think Roth conversions, looking at doing that now as opposed to when we have higher tax rates in the future is going to be a good one. Annual exclusion gifting, Roth funding. I think a lot of the clients on the call probably do this, but where we have a 15 or 16-year-old that is making enough money, gifting the money to that 15 or 16-year-old in order to maximize the Roth funding for that child can be an incredible long-term planning strategy. Deferring business expenses this year. So if it does look like there are going to be higher expenses next year, by deferring some of those expenses into next year, you're going to be taking advantage of that higher rate. Harvesting gains prior to year end, if that capital gains tax rate is going to go 40 to 43.8% and not being retroactive. I'm about out of time, so I'll leave you with this memorable quote. George Burns said, "I can't afford to die. I'd lose too much money." So.
All right. Well, that was wonderful, especially, and I love how you picked it up with other planning tips that we can, put in our tool belt. So thank you so much for that. That was enlightening. So we do have some questions that came in. If we can address those really quick. Go ahead. Are you seeing there's a whole lot of different things going on? Oh, Chris Steele, can you clarify whether the exemption is a bottom up instead of a top down approach?
I'm not sure what he's referencing there, to be honest. I do know Chris, so
oh, okay. maybe it's a separate discussion later then. And Lauren had a good question, and I think for our clients that do have a taxable estate at this point that are single, talk to us about what kind of trust would be appropriate for that type of person.
Well, so frankly, the easiest situation there is if there is life insurance out there looking at using kind of an irrevocable life insurance trust or an ILIT. In that situation, obviously they do not have the ability to use kind of that spousal lead access trust, but they do have the ability to use a simple irrevocable grantor trust there for the kids. The difference there, though, is again, they are irrevocably gifting up those assets. So the big thing I would say there is making sure that is something that they want to do and where they are not going to need that money in the future. And that is probably the most important conversation to have in that type of scenario.
Gotcha. And I just had a quick question because, we do have clients that may have existing irrevocable trusts, so maybe not necessitating creating a new SLAT. Do you see anything structurally different with grantor retained annuity trust or gift trust or any other? Could those be the same? Can we use those same trusts as long as
those are all pretty different types of trusts? The gift trusts are typically going to be used for more annual exclusion gifting, and certainly that can have the components of a spousal lead access trust. The one thing to be careful there is, though, with the spousal lead access trust, you're not going to be able to take advantage of that gift splitting. So whereas a married couple can give $30,000, $15,000 per spouse to each child, in a spousal lead access trust, only the grantor would be able to use that $15,000 annual exclusion. The GRAT or grantor retained annuity trust, we didn't talk anything about that today, but that would be kind of a completely different vehicle there. That's going to revolve around interest rates.
Okay. All right. When in doubt, talk to your estate attorney, right? All right. All right. Well, thank you so much, Michael. That was fantastic. And everyone, we're going to take a 5-minute break. So bathroom, coffee, whatever you need. And then we will continue with Julie Hall, our estate lady. So it's a estate.
Well, thank you for having me.
Yes. Thank you so much, Michael. Okay, all right. Well, we are ready to continue our second part of our quarterly this morning, and very excited to introduce Julie Hall, who is known as the Estate Lady. She's going to talk to us about personal property and estates and what every planner should know. Also, big fan, I can't see it here, Inheriting Clutter is what this book says with my background. There we go. And just wanted to also I think it's just so timely that Kay Sabetta of AARP Georgia gave us that statistic with regard to the older generation outpacing the numbers of the younger generation. And so what does that mean? We got a lot of stuff, and Julie is going to help guide us because as planners and advisors and professionals in this space, we can be very instructive to our clients with that. And so Julie, also known as the Estate Lady, is a nationally known personal property expert who has assisted thousands of individuals across the country in the daunting and painful process of managing their loved ones' possessions. So with over 30 years in the estate industry, she advises on distribution and dissolution of a property valuation, the game plan, so kind of taking a big picture step back, options for handling the estate, understanding today's market, minimizing family feuds, oh, that's huge, and clearing out the family home. Her expertise in turnkey services have been sought out by families around the world. She's been cited in the Wall Street Journal, New York Times, Kiplinger's, AARP, Consumers Digest, Bloomberg News. Very good. I mean, everything basically, including NPR and Smart Money Magazine. She writes and speaks on behalf of seniors, educating them on why it's important to have a game plan for their personal property before a crisis arises. Hall also educates their boomer children, guiding them through the entire process on behalf of their parents. Julie's passion is educating heirs, executors, and professionals in understanding the complexity of personal property issues. She's authored 5 books and hundreds of articles, white papers, and training curriculum. And since 2007, she has directed the American Society of Estate Liquidators and has led ASEL to become the #1 professional organization for estate liquidation professionals nationwide. Thank you so much for joining us today, Julie.
Thank you so much for having me. I want to thank everybody for taking this time to be with me this morning. This topic is of paramount importance because it's going to affect each and every one of us personally, maybe with a spouse, our parents, our grandparents, and even your clients. And we'll talk about that a little bit later. But this is a wonderful opportunity to open up and begin conversations with loved ones, particularly our parents, if you still have them, and older clients. Let's put it this way. The Great Depression era generation is about 55 million strong. The boomer generation is 100 million strong. So as we are losing the Great Depression generation, and we have been seeing that happening steadily for the last decade, their personal property is flooding the market for traditional household furnishings. When we get to my generation and we get to the stepping off place, there is quite literally a tsunami of personal property that is headed in our direction. And we need to know how to deal with it because right now we're not doing a very good job. So most of my clients will usually begin with one question: where do we begin? As an appraiser and someone who's been in thousands of estates over 30 years, I always say, before you do anything, you have to know what you have. You have to establish what has value versus what doesn't have value. And that means you need to have an expert come in, walk through the home, whether the resident is still living or they've passed away. It's important to get things evaluated. And here's why. It was just a few years ago when I was called into an estate. The executor was an elderly priest, and the individual who had lived in the home was a hermit, an eccentric, and the home had no air conditioning or heat for over 22 years. Well, I knew I was walking into a mess. And sure enough, when I got to the estate, it was in complete shambles. At one time, it was a beautiful split level home, but it had fallen in disrepair. And the amount of mold and mildew and critters that were in this house were quite overwhelming. But it was a museum on the inside. And I knew if these items were professionally cleaned and cared for, they were worth a small fortune. Well, the executor took me into the basement because I always want to see all the nooks and crannies. And in the basement, I saw laundry baskets piled up with stuff, broken stuff, stuff covered in mold. And I asked him, what is all this stuff in the laundry baskets? And he said, oh, all of this stuff is ugly, so it's going to Goodwill or it's going to trash. I bent down, I picked up a vase, which I knew was from a very rare potter. And I said, well, with all due respect, Father, let me clean this one up, but I think this vase is worth about $25,000. And look, there's 2 more just like it. So I'm not sure he believed me, but with his permission, I brought the pieces home. I carefully cleaned them and examined them for any damage. I communicated with the auction house of choice for those pieces, which just happened to be in New Orleans because those rare potters originated in New Orleans. And they ended up selling for about $78,000. And to think that those would have gone to charity or even worse in a dumpster just kind of makes my heart stop. So that's just one story of why you need to have things evaluated. The other reason you need to know the values is because if you don't know the values, if your loved ones don't know the values, someone else will. And that someone else, unfortunately, is usually the face of exploitation. And with regret, I've seen a lot of that in my career as well. Another reason, well, I call it heirloom stories, like the fish that got away. And every time they tell the story, the fish just keeps getting bigger and bigger and bigger. Well, the same is true with heirlooms. Somehow in the 1950s, that chair ended up being just a $50 chair. And fast forward it to 2021, and Julie Hall walks into the estate, and it was Abraham Lincoln's chair. So now it's worth a fortune. So you really need an objective third party to distinguish what's what. And also, I think it's really important to know the values of items to minimize future contention among heirs, as well as prevent hasty decisions. When my phone rings, often it's a family that's in crisis mode. And we all know when you're in a crisis mode, bad decisions can occur. It's also important to know the value of items for equitable distribution purposes. If somebody left their heirs $1 million in cash, that's really easy to figure out. You split it right down the middle if that's what they stipulated in the will. But personal property is a different animal. It's not so easy to split because there are many different kinds of values, including sentimental value, and lots of fights can break out. So establishing equitable distribution is important, but you need an expert to first place a value on those items. Another reason, which is kind of near and dear to me, is with all the sensationalized TV shows, which I shall not mention, that talk about the values of items. Well, we know in the industry that these values are not accurate. We know that they are superfluous. And so it's very important for me when I'm communicating and trying to educate people that they understand the real values, which are fair market values. Also, it's important for the executor of an estate to understand and secure the valuables because it is his or her fiduciary responsibility to do so. Now let's address some of the obstacles that people face with personal property. This has consistently blown my mind for over 30 years. People simply fail to plan. I mean, think about it. We inherit these items from previous generations. Maybe we're a collector and we've searched our life for some of these pieces. We display them, we care for them, we insure them, we show them off to friends, but we don't make a plan for them upon our demise. And so that's a really big obstacle. I think also another obstacle that I see in my own practice is a lot of my clients just don't want to face their own mortality. I'm not a lawyer, but I will at least say this much. The majority of people that I deal with don't even have a basic will. When I started in this industry 3 decades ago, roughly 50% of the people in the United States did not have a will. Fast forward to 2021, the statistic has changed. It's somewhere between 58% and 68% that do not have a will. This is simply not advisable. I mean, there are so many things that need to be dealt with, and personal property is one of the big ones. I also think an obstacle that people face is sentimentality. I'm as sentimental as the next person, but I do think that, especially when there's been a death and a loved one, a mother, a father, a spouse has died, people can really get stuck on the personal property that that person owned. And as we will discuss in just a little while, sentimentality does not equate to monetary value. Other big obstacles I see are a wide array of emotions. We see a tremendous amount of grief. We see anger and resentment from adult children who are feeling that way because their parents did not plan. I personally have seen enough greed to last 3 lifetimes. It is alive and well, unfortunately. And all of these emotions, plus so many more, can lead to and often lead to very poor decisions. Now, another big important part of what I deal with and what I see on a daily basis are the mistakes people make. And some of it is through no fault of their own, but with just a little bit of pre-planning with a couple of experts, they would have been able to avoid what we're getting ready to talk about. Some of the biggest mistakes I see, I would have to say the number one is people have unrealistic expectations. For example, mother paid $10,000 for that Persian rug. Today, they're thinking that Persian rug is going to bring them $15,000 or $20,000. But what they don't understand is that the market for Persian rugs and many other beautiful furnishings have truly plummeted. And today, they might only get $2,000 for that Persian rug. So often we hear people say, well, my mother paid $5,000 for that sofa and we want top dollar. We want $4,500 back out of it. That's simply not going to happen. So the burden of setting those expectations often falls on the professional, such as myself, or the professionals that they decide to work with. Other things that kind of hold the hand of unrealistic expectations is, especially when we're dealing with older clients, they don't take into consideration that styles have changed. Lifestyles have changed, right? We have a more simplified lifestyle. We're not really using formal living and dining rooms anymore. They haven't taken into consideration the size of some of their furniture. They could have a massive china hutch or a wardrobe. People are not really buying these pieces anymore because we're simplifying our lives, we're simplifying our homes, and we're just not wanting big, clunky pieces that are taking up most of the wall space. So I think this kind of complicates their issue of dealing with expectations. Another one is many of my clients will begin their conversations with me by saying, oh, Julie, I have a house full of antiques. They think that old means value, and that is not the case. There are many characteristics of value, and age is one of them, but it's not the top one. And I would always affectionately tell my client, you know, they made junk back in the 1800s too. And we have to understand that it's not just about age, and condition has a lot to do with it too. I think that our clients underestimate the process of planning, the process of downsizing and thinning out the house, the process of trying to simplify their lives, or if mom needs to make a move, to assisted living or a dementia care, the children are thrown into a tizzy. And so I find that people are not taking enough time and certainly not enough thought. They're not giving thought to preparing what may lie ahead. Also, they're not making a plan for their possessions. I see a lot of people, especially the elderly, who just say, no, I'm just going to let my kids fight over it. And that has a tendency to make my hair stand on end because I see those fights and I'm in the middle of those fights. And it's really an awful thing. And the parents just don't understand that the children are not going to just fight the week of their funeral. They're going to fight for the remainder of their lives or just not even talk with one another, which is very, very sad. So they're not planning for these things, their possessions, in advance. They're not seeking professionals like you, like me, to help them with their finances, to help them with their tangible assets. If they were to pre-plan in advance, and this is where you can come in and kind of open up the conversation to not only your current clients, but also prospective clients. This is a wonderful way to open that conversation and start building trust. I have also found that our older clients do not share their final wishes with their adult children. This is really a travesty as far as I'm concerned. They are known as the silent generation. They often don't want necessarily their children to know about their financial state. They don't want them to, they don't even want to talk about their final wishes. But this is something that the children should not be left to guess. And so I am a big proponent in having those conversations prior to death, getting their financial situation and affairs in order, understanding and organizing their legal documents so that people left behind know where they are, that kind of thing. And another very, very important mistake: the children do not know the location of legal documents, titles, deeds. They don't know passwords. They don't know the location of keys. You know, maybe dad's got an old muscle car in the garage, but nobody can find the keys to it. These are very important conversations to have. And these, I would say, are the top mistakes that I see adult children and their elderly parents making. So the bottom line is, don't do anything. Don't throw anything away. Don't even donate it. Just wait until a professional gets in and they can help ascertain what has value versus what doesn't. Very important. So what factors affect value? Well, the current economy and the personal property market, which I follow on a daily basis. If the stock market is at a high, then usually things like precious metals are a little bit lower. If the economy is a little bit rocky, we see metals and other tangible assets starting to go up a little bit. With this tsunami of stuff that's headed in our direction, we also need to take into consideration the law of supply and demand. As we lose the Depression era, and we're seeing this, the beginnings of this tsunami of their traditional furnishings, the market has become saturated. That's why the values of antiques and a lot of their painted porcelain and china and crystal and such has declined in value. Well, you look at my generation, I'm a boomer, I'm at the tail end of the boomers, but we're downsizing. We want to simplify our life. So we're also contributing to the saturation in the marketplace because we're getting rid of our traditional things. And then you look at the 30 and 40 somethings, and they are well established. They have their own home or apartment, and they don't fill it with the tchotchkes that grandmother had. And then we look at the 20 somethings. Well, they just don't want anything but a couch and a table and a lamp. Very, very simple, minimalist mentality. And I can't say that I blame them. But when you have so much stuff and not enough demand, obviously the prices are going to decline. As we touched upon a moment earlier, we also have to look at those different styles. You know, something from the 50s or 60s may be really hot today, but something from the 80s or 90s or mom's floral couch, that's just not going to sell today. You would be lucky to be able to even get someone to take it on donation. So we look at the trends, we take trends into consideration, and the trends right now are to simplify, to get organized, to pare down your life, and so that you can enjoy it and not be stuck taking care of all the stuff. Something else that affects value is the condition of an item. And I'm talking about good original condition, whether it's an antique or something that's more contemporary. I had a client, very wealthy client, and she had this magnificent Ming Dynasty vase. Oh, it was just beautiful. And I always enjoyed holding it when I was at her house. It was one of her prized possessions. One day, she called me and said, "Oh, Julie, please stop in. I want to show you something." It's like, okay. So I popped in when I was in the area, and she showed me her Ming vase, her Ming Dynasty vase again, only she had had the local handyman drill a hole through the bottom of the vase so she could make a lamp out of it. Oh, there goes my heart again. And she said, "Isn't it a beautiful vase? I mean, isn't it a beautiful lamp, Julie?" Oh, yeah, it's a beautiful lamp, all right, but you just killed the value. So when people alter the original condition of an item, value is negatively affected. So if you paint, if you refinish, even if you refinish a piece, that can have a negative effect on value. If it's been broken, re-glued, if the top and the bottom don't go together and they've just kind of been married through the years, all of these things have a negative effect on value. And another one is the piece desirable? Is it sought after in the marketplace? A lot of our older clients have 4, 5, 6 China sets. Well, guess what isn't selling very well these days? It's China, because we don't formally entertain. And when we do entertain, it's on a casual basis. So a lot of our elderly clients, female clients, do not understand how a $2,000 set of China is now selling for $100, $150. And then another thing that affects value is collectors from long ago would go for quality, but they would also go for quantity. So it is not unusual for someone like me to walk into a home and find 300 vintage cookie jars or 200 pieces of American pottery. Today's collector is different. Today's collector is very selective. They may only want 10 pieces in their collection, but they're going to be the 10 best pieces they can find. So what happens to the collector with the 300 pieces and they die, and then their children sell it all at once? Maybe it goes on an auction platform. That collection has just saturated the market even further. So the top few pieces will sell very well, but what's going to happen to the remainder of the collection is that they're going to sell for practically nothing. What personal property should be evaluated? Well, here are some ideas. Definitely jewelry needs to be evaluated, and I would encourage you to take jewelry not to just any jeweler, but primarily someone who deals with estate pieces. You want somebody who understands and who can, there's so many fakes that are coming out now, even things that are marked 14K, 18K gold that aren't gold at all. So I would encourage you to take it to somebody who specializes in estate jewelry. So we've got the metals, we've got the gold, the silver, the palladium, the platinum, and such that are all very collectible. And then coins, if there are coin collections, whether they are American or older foreign coins, silver, primarily silver, a lot of our older American coins, such as the Morgan dollar or the Walking Liberty, are extremely desirable today. And they're usually in a 1 ounce large coin. Also, gold coins. These are very important things. And I'll just tell you this, this is why our clients need to be educated. My first instruction to all of my clients, if I'm handling the estate, do not throw anything out. You let me do that. You let me decide what needs to be thrown out and what can be sold. I walked into an estate. I had told the 55-year-old son, don't put anything in the trash. What did he do? He started throwing everything in the trash. So we had to go through the trash bags. Well, what do you think I found in one trash bag? I found antique fountain pens that did have some value. And I found 3 solid gold $1 coins. Now, if you know anything about gold and if you know anything about coins, these coins were worth roughly $1,700 a piece at the time. I called the son to say, you threw out gold coins. And he goes, oh yeah, but they're only worth $1 each because they're only dollar coins. He forgot to take into consideration the weight of the gold. And those coins are bullion, so they are literally worth their weight in gold. And we found other things in the trash too that were worth quite a bit of money. Guns, ammunition. Today, these things bring premium dollars. Historic or military items, there are always collectors for virtually any war we've ever had, with the Civil War being the #1 collectible. Fine art always needs to be evaluated. Most of the time, it doesn't have the value that people think, but it still needs to be looked at, because in some of these older estates, we might find 1 or 2 pieces that do have significant paintings. Unusual antiques. Lots of people just have very common antiques that we see every day, but if you have something very unusual, it will command more than the others. Vintage and antique toys, as long as they are in excellent condition. The problem is there are not that many that are in excellent condition, because where are they stored? Up in the attic or in the basement, where they are exposed to heat and cold and dampness and humidity and critters. And so they're usually not in very good condition. And most recently, I was doing some reading. I came into a collection of Pokemon cards, of all things. And it wasn't the one that I had, but upon doing some research, one card recently sold for $250,000. Go figure. But you just never know what's going to have value. And if there's items in the home or the estate that have provenance, which is documented proof that this item actually belonged to this individual or has a documented history of the piece, that's always very helpful to establish value. So the thing that I love to do the most as the estate lady is to help people formulate a game plan, because it's the one thing that they don't have, but that they need. So I always explain to them, what's headed in our direction, and that we need to make a plan for these things sooner rather than later, because if we don't, it falls on the shoulders of our children, who still lead busy lives, who still work. And I see these children and they become resentful over time that their parents did not do this. So I am a big believer in encouraging our parents, our grandparents, our older clients to begin thinning out the house. Now, the older generation seems to have a pretty serious problem with paper. They collect a lot of paper and documents, and they've never shredded, and they've never gotten rid of things. And I had one client who was 102 years old, and she had kept all of her taxes back from World War II. And I said, you don't need to hold on to these anymore. And she's just wasn't very trusting. So that's why she always held on to them. But we were able to have them all shredded for her. So thinning out the documents that aren't needed and the paper, sorting through and organizing the paperwork, your financials, your medical statements, your insurance, the house bills. So many people do not organize this. And by the time I get into the house, it's just in a giant jumble. It's really important to throw away broken and obsolete items. And when I say broken, I mean, handles on teacups and cracked and re-glued dishes. Just let it go. Obsolete items, I am referring to the 1972 hand crank ice cream machine that's been under the sink since 1973 and it's broken. So just let it go. I'm also a really big believer in encouraging open dialogue between the adult children and their parents. Their parents are from the silent generation. They keep most of their matters private. And a lot of the adult children in my age group, they just don't know how to approach this. And I always say, approach it with love, but approach it. Just say, mom and dad, it just dawned on us that we don't know what your final wishes are. We don't know what you want done if, heaven forbid, something horrible happens and you can't speak for yourself. We don't know what plans you have for all the possessions in the house. We need to talk and then start that way. It also helps if you find the right professionals and the right resources. Someone like myself can go in and visit a home, and within 2 hours, 2.5 at the most, I'm going to have the estate figured out and I'm going to write them a game plan. And that game plan includes professionals that they need to contact along the way that are going to help them achieve their goals. So finding them in advance, like a professional organizer, a senior move manager who can come in and just take the bulk of the move on themselves and get mom or dad moved safely and putting everything back together in their new home very much the way it was in their old home. And it also includes someone like me who is an estate expert or a personal property appraiser that you can find in your area. And I think the last topic I would like to speak with is about building relationships. I think a great part of my success has been being approachable and listening. But I think it's also been about building relationships. And I'm referring to you and your clients and myself and my clients. And it's really important that we just start opening that door and then having some of these conversations to kind of get them moving in the right direction. I have found that the bulk of my older clients will not make important financial decisions, either with their money or something like selling their house and moving, because they're overwhelmed with all that they have accumulated. And understand that it's not just what we have accumulated. We have become a storage facility for previous generations too. We're taking on our parents' stuff, grandparents' stuff, great Aunt Josephine and Uncle Joe. So at some point, we either find a home for these items in the family, or we have to start letting them go. It's the perfect opportunity to have these conversations about their items, about the possibility of downsizing, about the possibility of moving. So if somebody is wanting to, from a financial perspective, make things easier on themselves, and they want to leave the 4-bedroom home and move into a 2-bedroom condo or patio home, that's where you come into play. And I think it's really important that you recognize, that we all recognize, that this is a very difficult time in our clients' lives. I mean, they could be facing a devastating illness. Many of my clients will confide in me and tell me that they're terminally ill, or they're dealing with an advanced diagnosis. And it could even be a divorce, which is also very difficult to deal with. But we're not dealing with people on the best of terms. They're just not okay at the moment. And I think this door, if we're willing to walk through it, can open us up to building relationships based on trust. And I also think we can earn their business, not just for the short term, but for the long term as well, because you are giving them a glimpse, and I'm giving them a glimpse into our futures and the things that need to be done to make sure that when we do leave this place, we are leaving it as smoothly as possible, being careful not to put too much on our children. And I have found in my career that those who planned in advance versus those that haven't, there's a world of difference between their children. One of them has angry, resentful children, and the ones that planned have children that realize the love and the depth of care and concern their parents had for them, so that when they did die, it's still going to be hard, but they would have less things to deal with. So we're giving them a glimpse into that future. And as I always like to say, a prepared mind is one that has peace. And I just want to thank you all very much for taking the time to listen to me today. And if anybody has any questions, I'd be delighted to answer them.
Oh, I love that quote. That's wonderful. Thank you so much, Julie. And we do have a few questions. Also, Julie Teplis, she asked just maybe some general advice about, appraising art. I think when we go through our client's net worth statement exercise, typically, we might ask about art. Of course, we ask cars and bigger items. But she said just any advice about art when we have clients that have art.
Well, it's a multifaceted question, actually. But if my answer is going to be to try and locate a certified personal property appraiser in your area. You can do that through the American Society of Appraisers, ASA, or the International Society of Appraisers, ISA. There's many of them here in the United States. And I would start there because many of us, I'm a generalist, and I can do art to a point. Now, if you know going into it that there is value in some of their art, or you have a client of high net worth, then my recommendation would be to find a fine arts appraiser who specializes only in fine art.
And Wayne, he had a question. Many people don't know who to trust with regard to assessing an estate and are reluctant to seek help. How do you suggest people determine who to trust in this type of situation?
That's a great question, Wayne. I've spent 30 years building trust, and I can tell you I've seen some real horror stories out there. I say that the client has to put a little skin in the game. They have to research the person they're getting ready to hire. Talk to references, check out their online reviews. If they're working with an attorney, if they're working with a financial planner or advisor, make sure that it's a good name and with a good reputation. And of course, ask them a lot of questions too. My best piece of advice is please use your gut instinct. If something tells you something isn't quite right, then do not use that person. But if anybody ever needs any advice on estate liquidators, they are welcome to contact me at theestatelady.com. I would be happy to point them in the right direction.
And Kay, you had a great question. Did you want to ask your question?
No, it was really more of a comment and
Oh.
astonishment with the Pokemon cards. And I have a 26-year-old and he was obsessed with those. So I know we have some stashed around the house and I'm going to be looking for those boxes this weekend.
Yeah, do not throw them away, because at the very least, they're worth like $4, but a lot of them are worth 15, 25, 100, 1,000. So hold on to them.
It adds up. Yeah,
It
that was
does.
a great tip. Thank you, Julie.
Mhm.
You're welcome.
And what about Beanie Babies? Did we cover that too?
I can address it,
Okay.
but I want to be polite about it. Like the Franklin Mint plates and figurines, I wrote a blog once called Franklin Got the Mint, but Susie Got the Shaft. I see a lot of my clients who have spent easily $100,000, $200,000 on these collectibles, on the Franklin Mint, on the Bradford Exchange, on the Beanie Babies. And I think what happened is these manufacturers shot themselves in the foot. Oh, they made a fortune, but they made so many of them that they're, supply and demand. No, there's too many of them on the market. What we see with Beanie Babies now is the majority of them are being found at yard sales for 50 cents. Now, that doesn't mean that a select few, like the Princess Diana one, but you've got to have the right ear tag and the right color and the right flower. And some of them do still have value, but you'd need to take it to somebody who knows Beanie Babies. But unfortunately, the bulk of them don't have much value.
Excellent. Oh, Brandon actually made a suggestion. He said all cards now go through PSA, which is an evaluator and grader of cards. Are you familiar with that resource, Julie? PSA?
A little bit. Is he referring to the Pokemon cards?
I think so.
Yes.
Okay.
I think maybe that's more for Kay too.
Oh, okay. There you go. An evaluator and grader of cards. All cards. He says all cards.
All cards. Okay.
Okay.
Thank
Okay.
you.
Wow. Baseball, football. Okay, gotcha. Thanks, Brandon. That's
Thank
excellent.
you.
That's good to know. Awesome. Well, does anybody else have any other questions for our estate lady? All right. Well, with that said, thank you for joining us, everybody, this morning. And big thank you to Kay Sabetta of AARP of Georgia, as well as Dan Mineta of First Trust for joining us as well and supporting our efforts this year. It's been a really great year in spite of our circumstances. We've come together, and I've been so pleased to see all of our great members here at the event. So thank you everybody for joining us this morning, and thank you for Michael Burns this morning for our presentation. It's enlightening and helpful. So thank you all. Have a great day. Have a great weekend. All right. Bye.